And stocks are rising today, setting the major averages on track for their fourth consecutive day of gains ahead of the U.S. Thanksgiving holiday. One of the top gainers is Oracle, despite ongoing concerns about its corporate bond sales. Analysts argue that the recent sell-off is overdone. Let's welcome Eric Sterner, Chief Investment Officer at Apollon Wealth Management. And Eric, thanks very much for joining us.
Oh, Roger, thanks for having me.
So let's talk about Oracle off the top. People are saying it's undervalued. And they're undervaluing its partnership with OpenAI, but its credit default swaps have hit new highs. How do we balance all this?
Yeah, I think that was really, Oracle and all the hyperscalers really, it caused some concerns within the market. Certainly there's been on and off concerns about the high CapEx spending, but knowing that they went to the the bond market to issue some debt. We saw Google issue $25 billion in bonds, Meta $30 billion, Oracle $18 billion, Amazon $15 billion. I think it just caused some concerns amongst investors, but I think investors shouldn't be too concerned there because these companies, the majority of these hyperscaler companies, their balance sheets are extremely healthy. And in fact, they still have very large cash balances. In fact, some of them could actually have more cash than debt. I think it's more of a strategic decision and capital efficiency to preserve some of that cash for other strategic initiatives. So I think the tech rally still has plenty of legs to go, including Oracle.
And relatively speaking to those companies, those bonds that isn't that much, is it?
Exactly. It's those companies have very low debt. And so I think the market just was a little, took some time to digest that news, but it seems investors are back and the markets are back in the green today and have been over the last few days.
And now Google and Nvidia tweeted, or on X, I guess we should call now, that its GPUs are a generation ahead of Google's AI chips. What do you think of that statement and doing it that way?
Yeah, it should be interesting. Obviously, Nvidia has been the biggest of all the mega techs, and now we've seen a tremendous run. We've seen a tremendous run by all these mega techs over the past nearly 3 years, but Google has certainly just gotten a really strong returns over the past several days. So it'll be interesting to see as they go head to head with Nvidia, and we know AI is, or I think many of us believe AI is still very much in the early innings. So it'll be interesting to see how these two position themselves going forward.
And is there room for both of them, do you think?
I think so. This AI movement is so big, and it's going to really affect every sector in our economy. So I think and it's a worldwide phenomenon. So I think there's plenty of room for both. And I think there's certainly plenty of earnings amongst both of them, as well as the other mega techs. So I think it'll be interesting to watch.
And now we're seeing, looking at some of the stories, the sleeping giant in global AI is how Google was described, is now fully awake. Is this just the start then, do you feel, for Google?
I don't know if it's just the start. I think it's just the continued the strong rally in technology that we've seen over the past 3 years. And I think, we still have plenty of room to grow. And while, there have been some pullbacks, and I think pullbacks within the market, especially technology, are healthy because, yes, these valuations are a bit frothy. You look at the top 10 within the S&P 500, their PEs are typically in the 30 range, while the other 490 are in the 19 range. But their earnings quarter after quarter between Google and these other top 10 companies are just outstanding. So they are priced for perfection. So eventually we may see some slippage within their earnings, whether it's past results or maybe even forward guidance. But right now, those strong earnings are continuing. So I think we still have plenty of runway with this rally.
And we've got the S&P up there right now. I want to get your thoughts on JP Morgan projecting the S&P 500 could hit 7,500 by the end of 2026, maybe even 8,000 if the Fed continues to cut. Deutsche Bank sharing a similar outlook. Do you think those are reachable?
Certainly, if I mean, there's plenty of risks that the markets are navigating. I mean, if everything goes as planned and we avoid some of those potholes within the market between a weakening labor market and rising geopolitical tensions, that's very possible because we've seen such strong earnings. We just saw the third quarter earnings, four straight quarters in a row of double-digit earnings growth. We see net profit margins at 13.1%, which is the highest since 2009. And even the revenue growth was at 8.4%, which is the highest it's been in 3 years. And all 11 sectors experienced higher revenue growth. So I think the corporate health of the S&P 500 companies is extremely strong. The weakening labor market is something to watch. I think this economy can continue to potentially grow with less jobs just because of all the productivity gains through AI and less labor supply with aging demographics and the limited immigration policies. So is it possible? Yes, but we need a lot of things to go right and to avoid any of those potential potholes, such as rising unemployment or any dent in consumer spending.
I want to try and get in two last things. What sectors are you currently favoring right now with everything that's swirling around? What are you looking at?
Well, I mean, healthcare had been in a rut, all year, and you see that it's not unusual with the new White House administration because there's policy uncertainty. But I think these weight loss drugs are, besides AI, the second most innovative trend in the markets right now. And now we've seen some of those hurdles clear. We saw some supply bottlenecks earlier this year. That's been cleared. The biotech companies have a new deal and working with the White House, where in return for lowering the cost of some of these drugs, they're going to get more coverage on these weight loss drugs through Medicaid, potentially, or Medicare and potentially Medicaid. And that's a huge industry. Just getting that coverage opens it up to 40 million more consumers. And it's expected that weight loss drug industry will be bringing revenues of $150 billion by 2030. So I think this healthcare has been an ignored sector really this year, and even 5 of the last 6 years has trailed the S&P 500. So I think there's plenty of room to rally within healthcare, and we just saw Eli Lilly become a $1 trillion market value. So I think there's more room to run there.
Okay, we're going to have to wrap it up there, but Eric, thanks as always for joining us.
Thanks for having me.
Eric Sterner is Chief Investment Officer at Apollon Wealth Management.